The U.S. market is in big trouble, with loan values dropping hard across many banks. Many worry what will happen to the economy if this progresses to other banks across the country. With the crash of Silicon Valley Bank and of Signature Bank, the situation is looking grim across the nation, and the problem could soon worsen. The U.S. market has seen a huge downturn in many of the assets banks must hold by law, such as the US Treasury, mortgage-backed securities, and other bonds. This, along with stocks, leverage loans, and derivatives, which have also been dropping, has led to massive unrealized losses for U.S. banks. In fact, by the end of 2022, the unrealized losses for U.S. banks were around $620 billion. This, along with the fact that much of the money banks possess are in deposits and little in real cash, makes the situation even more unstable. Back in March of 2020, the Fed lowered the reserve requirement ratio to 0%. This makes a bank able to have many billions of dollars in deposits, but as little as $40 million in actual cash. Because of this worrisome situation, we could see many depositors withdrawing their money from the banks, leading to banks being forced to sell many of their assets at a loss to keep up the demand. We could also see these banks raising money through stock and bond sales, similar to what SVB did before. This could in turn lead to even more runs on the banks and yet worsening the situation. With banks collapsing, we could see a decrease in account limits in their credit lines and/or credit cards. This is very dangerous to small businesses, who often rely on credit to grow. With small businesses struggling, we could see even more problems arise from this development, such as job loss. With reduced lending, banks may become more cautious about lending, which can reduce the availability of credit for businesses and individuals. This can slow economic growth and potentially lead to job losses. Small businesses are significant employers in many communities. Without them, many people would lose their jobs, leading to a rise in unemployment rates. This, in turn, would reduce consumer spending, leading to a decrease in economic activity. Reduced innovation. Small businesses are often the driving force behind innovation in industries. Without small businesses, there would be fewer new products, services, and ideas, leading to a lack of competition and stunted growth in industries. Decreased community support. Small businesses often support local events, charities, and organizations. Without small businesses, communities would lose valuable sources of support and funding. Monopoly by large corporations. Without small businesses, large corporations would dominate many industries, leading to decreased competition and potentially higher prices for consumers. This could also lead to a lack of diversity in products and services. Lower quality of life. Small businesses contribute to the vibrancy and character of communities. Without them, neighborhoods could become less lively and less appealing to residents and visitors. These bank collapse might lead to turmoil for the U.S. financial sector and might well just worsen. J.P. Morgan Chase CEO Jamie Dimon has warned that this progression could ripple throughout the economy for many years to come. This, with increasing interest rates, are extremely worrisome for small businesses trying to operate. And even with billions of dollars in lifelines for other big banks, it still isn't enough. Another big contributing factor is inflation, which has been brought on in big part by the increasing housing cost and the lack of affordable housing in the market. With prices going up at around 8.1% year over year, this is a truly devastating situation for buyers. When inflation occurs, the nominal value of loans stays the same, while the real value decreases. Nominal value refers to the face value of the loan, while real value refers to its value in terms of purchasing power. As inflation increases, the value of the currency decreases, meaning that the amount of money required to purchase the same goods and services increases. This leads to borrowers repaying loans with money that is worth less than when they borrowed it. It can also lead to lenders experiencing reduced profitability and even losses if they cannot collect enough interest to keep pace with inflation. As a result, loan values can decrease in real terms, leading to reduced returns for lenders and increased debt burden for borrowers. Other negative progressions we could see hit the economy include higher interest rates. If banks are making fewer loans, they may seek to increase their profitability by raising interest rates. This can make it more expensive for borrowers to take out loans and can slow economic activity. Financial instability. If declines in loan values are widespread and severe enough, they can lead to financial instability for banks, potentially resulting in bank failures and broader economic repercussions. Stricter lending standards. Banks may respond to declining loan values by tightening their lending standards, making it more difficult for borrowers to qualify for loans. This can further reduce the availability of credit and slow economic growth. Reduced profitability. Because of declines in loan values, it could result in lower profits for banks as interest income from loans decreases. Banks may also need to increase loan loss provisions, which can further impact their profitability. The collapse of a single bank, being Silicon Valley Bank, was enough to send a ripple effect across the economy. Many workers in tech firms as well as engineers lost their job when the support from SVB disappeared. Small businesses have it hard as is, but if they lose the bank they relied upon, they simply can't keep on going. As discussed earlier, Silicon Valley Bank crashed because of a drop in the price of their assets and depositors withdrawing large amounts of money. But this didn't just lead to one bank collapse. After having heard of this bank crash, depositors got scared and quickly withdrew their money from other banks, such as Signature Bank, since it was closely tied to SVB. This led to Signature Bank crashing the same and sending the economy into turmoil. These are two of the biggest bank crashes since 2008, both being banks deeply connected to the tech industry. This led to many big tech firms being affected by the collapse of SVB, such as the streaming device maker Roku, the digital media firm BuzzFeed, or the online game firm Roblox, to name a few. This is not a good development for the future of the US economy. We can expect to see the economy slowing down, and thereby progressions for things to change taking longer at best. And at worst, we could see even more banks collapsing, reminiscing of what happened back in 2008 during the financial crisis. Furthermore, this crisis has many countries losing trust in the US and its financial and technological sectors. The US is set to lose global influence if this progression keeps going, and with the already weakening dollar, this clearly is not a great development for the country. Because people are scared to invest in banks, many banks have started campaigns offering bonuses and money for people to invest in their bank. Some analysts say that US banks are dangling promotions to lock in customer deposits. An example would be Capital One Financial Corp that offers a $100 bonus for opening a new account and keeping more than $10,000, and the offer goes up to $1,000 for investments over $100,000. This is a desperate attempt to get more customers and not have their banks crash along with the other ones. Many banks are denying the correlation between the bank collapses and these offerings, claiming they are simply to help stabilize their customers' personal finances. But considering many of them came around March 2023, along with the collapse of SVB, it wouldn't be wrong to assume this is a last-ditch effort to get some customers investing in the banks so we don't see even more bank collapses. The Federal Reserve also warns that interest rates are only set to keep going up. This will worsen U.S. banks' investment portfolios and potentially lead to even more bank collapses in the long run. How this will pan out in the future is uncertain, with some worrying that the whole U.S. economy is on a downward spiral and that we're leading into another financial crisis like the one in 2008. But for now, nothing is certain, and all we can do is watch as this unfolds in front of us and hope that the elites know what to do to fix this.